Okay, great. Well, good morning or good afternoon, depending on where you are in the country, Lutheran Services in America community. Great to have you all here today for today's Strength and Service webinar about the state of the insurance market, forecasting risk and opportunity. Always a pleasure to be able to host and to offer these Strength and Service series webinars especially with our corporate partners, which is all about focus on identifying and seizing opportunities in today's uncertain climate, all with the goal of helping you and your organization move forward. I'm really pleased today to introduce our guest speaker from Johnson Kendall Johnson, JKJ, our good friend Raphael Hachiski, Vice President at JKJ. So Raf is back by popular demand. They held a terrific and really informative webinar last year. We've had several requests for updated information from them. So pleased to have Raf here with us today. Before we get started, I want to mention that Johnson Kendall Johnson is a really strong partner of Lutheran Services in America and our community. They've grown to be one of the premier insurance brokerage and risk management firms in the United States. JKJ provides value-added and unique solutions with the most creative talent in the industry, as you'll soon be able to see and to hear from Raf. So today he's going to discuss what's driving pricing in the insurance marketplace and how to prepare your organization. You'll leave, we hope, understanding the various types of insurance coverage, from cyber to property to liability, and learn about forecasts for the senior living insurance sector in the coming years. As always, we will have time for Q&A at the end of the presentation. Feel free to enter questions in the chat throughout, and we'll try to make this somewhat interactive, but really hope you'll be able to ask your question. We have a relatively small but mighty group today, so I hope you'll be able to come off mute, and ask your question directly to Raf. So with that, I'll turn it over to him, and Raf, let you take it away.
Great. Thank you, Ken. Appreciate it. And thank you to all the LSA folks for putting this together, especially Kim and Liz and you, Ken, for doing this. I know it being a Monday and we're talking insurance, it can be a little bit difficult to stay awake. So thank you all for joining today. And as Ken said, definitely make this a conversational hour here. I'm going to try to be as succinct as possible and make it as entertaining as possible, knowing we're talking about insurance, not the most sexy topic, but it's going to be fun. So hopefully you walk away with a little bit of information that you didn't have at the beginning. So thank you again. So again, today we're going to be focusing on a couple objectives. First off, as Ken said, we're going to be talking about what's driving pricing right now in the insurance marketplace. As you can imagine, post-COVID, we've seen a little bit of a fluctuation in pricing and premium ratings across the board from carriers. So we're going to dive in to see what's causing that. We're also going to focus on the trends and the insurance requirements. What we're seeing right now is a lot of underwriters at the carrier level coming back and instituting requirements that weren't applied to us previously. So we'll talk about those, as well as what we're doing to mitigate those cost increases. And then finally, the elephant in the room, I would say, in the insurance world and really everywhere is cybersecurity, cyber insurance. So we'll do a little deep dive into that area near the end, just to focus on what's forecasted in that sector. Here's the brief agenda, just to give you an idea, just to keep it all on track. We'll just do quick introductions, then a little insurance 101, just to make sure we're all up to speed. We'll talk a little bit about the current insurance market environment, and then we'll talk about what we're doing at JKJ to stay ahead of the game for our senior living and human service providers. And then finally, as I mentioned, we'll talk a little bit about cyber insurance. And then as Ken mentioned, we'll hold it for a little bit for some Q&A at the end. So definitely, and if any questions you have, feel free to put them up into the chat, or otherwise we can unmute you near the end and we can have just a conversation as well. So first off, again, my name is Raphael Hachiski. I'm a former attorney turned insurance broker. So I get to see people's souls leave their body when I tell them what I do, because it's so boring, but we try to make it fun. And at JKJ, we are actually a very unique brokerage in that we are independently held. We are not affiliated with any of those big alpha house brokerages. We were founded back in 1956. I was not there, but at the time, we were starting to focus in varying industries as opposed to geography. What we find is that a lot of our competition out there focus on a geographic geographical area, where at JKJ, we really decided to focus on those high-risk industries that needed an intensive level of service. And as you can see here, a lot of our industries we focus on: construction, technology, manufacturing. We do the insurance for the Philadelphia Eagles and the Washington Commanders, actually. But really, our senior living and human service portfolio is our biggest book of business, and we're proud to partner with those not-for-profit providers across the country when it comes to their insurance and risk management. When it comes to senior living specifically, JKJ actually insured the very first CCRC in Pennsylvania, the Folkways at Gwinnett, back in 1969, where they're proudly a client still today. And we're proud to boast about a 98.5% retention rate when it comes to client retention, really before affiliations and acquisitions. And I think it's because of the service level that we provide our clients over and beyond just the placement of insurance. And we'll get into that a little bit. And then the trivia question du jour, actually, the Johnson companies, before it became JKJ, back in the 80s, instituted the very first 401k plan. One of the guys in our office discovered that 401k loophole. We are account number 0001 when it comes to 401k, and it allowed the employer to match the employees in their retirement funds. So we can, you're welcome for all that, actually. There you go. So, so really at JKJ, I like to use that term, outsourced risk management department services. You know, when we work with clients, we become an extension of the organization from a risk management standpoint. There's about 6 people on the team for every single client of ours, and we really focus on proactive risk prevention, aggressive claims management, as you can see, and programs to use that we can reduce losses, reduce claims activity for our provider clients. I think I mentioned we work with about 350 plus health and human service providers at present. That number is currently growing, fortunately. But really, it's a hands-on approach that we know that really it works a lot better, as opposed to just us coming in, placing insurance, high-fiving for the renewal, and then not seeing you for another 9 to 10 months. At the renewal stage, once that's all done, and you know that's a lot of work in and of itself, but once that renewal is done, we are all getting back together about a week or two following the renewal, and we're action planning the policy here. We're going to say, what are we doing from a safety and risk management standpoint that we can then sell back to the insurance underwriting community that will be the story to tell about that organization? What are you doing to address the claims, the risks that are all emanating from the organization, as opposed to just sort of crossing your fingers and hoping that you don't have any claims for that year. Really, proactivity is the key when it comes to working with us. This is just a little representative client list from a senior living perspective specifically. And the 2 things that really jump out here are, as I said before, geography. I see a community that's in Maine. I see a community here that's in Washington State, and everything in between. And then also size. We work with multi-state health and human service providers, multi-site, but also single-site communities. The exposures really are similar across the board. And when we have our safety guys out there, it's we know a thing or two because we've seen a thing or two, and we know that if there's a problem at 1 or 10 of our community clients, likely that the other folks are experiencing that as well. So that's really the collective portfolio knowledge that we like to leverage in your favor. So let's go into Insurance 101 very briefly. These are the sort of a list of the coverages that you'd want to be considering when putting together your renewal program. I'll go through these very quickly because I'm hoping that most of you have these in place already. Obviously, you have your property and auto. That's your first party stuff. You have your general and professional liability. That's third-party actions. That's when you get sued for wrongful acts arising out of the services that you're providing at the community. The umbrella coverage there is to cover motor vehicle accidents, sexual abuse claims, things that will creep up and above the general and professional liability aggregate. Workers' compensation, that's the statutory coverage that you get to protect your employees. And then you see what I like to call management liability lines: directors and officers coverage, employment practices coverage, fiduciary, crime. All of those are to protect the organization from a financial standpoint, as well as the direction of the organization from a board level. Then you'll see cyber liability. I mentioned that before. We're going to go into that in a little bit. That's for your really first party stuff, your cyber technology. as well as the third party. So when you get breached, you get hacked, and a hacker has your notification records, that's going to happen from a lawsuit standpoint, that you have requirements to notify those parties that have been breached, and the cyber liability program will cover that. Your pollution legal liability, that's going to be covering things like your underground tanks and whatnot, but also it's going to be covering MRSA, Legionnaires, things like that that are emanating from the community. And it's because of the fact that from the GLPL standpoint, a lot of times they'll have pollution exclusions within those policies, which then has created this standalone pollution legal liability coverage. And then on the right, you'll see some other throw-ins, active shooter. Unfortunately, that's a requirement for certain states. We've seen a lot more clients of ours purchase that coverage. Volunteer accident, which I like to call the workers' compensation coverage for volunteers when they get hurt. Let's say a volunteer breaks an arm, sprains an ankle, or has to go to the doctor and incur some medical expenses. That volunteer accident coverage will pick up on that. And then surety bonding, event insurance, resident trust fund, builder's risk. That's an area that we've seen a lot in. A lot of folks have been doing a lot more capital improvements and renovations and whatnot. And the builder's risk program is set up to protect incidents out of there. So these are the coverages that you want to be considering when you're formulating your insurance renewal program. So if we took $1 out of the insurance premium and we said, where does that dollar go to? About 30 to 40% of that dollar is going back to the carrier. And that money is going to be going into administrative expenses. It's going to be paying the broker. That's how we earn our money. When we place business on behalf of our clients, we receive a commission from the insurance carrier for that line of coverage. And so they have to have fixed costs there to cut out to provide payment to the broker, and then other expenses that come along that way. The other 60 to 70% of the income that they get out of that dollar goes back to investment, but also to losses. So when losses do occur, a lot of these carriers take that piece and they pay it back, and they create what's called a loss ratio. And a loss ratio is essentially the premium dollars, and on top of that is the claims that have been paid out. And so if the number of the loss ratio is lower than 100%, really lower than 50%, then you're doing okay. If it's any higher, then we know that the insurance company is paying out a little bit more than they'd like to, and it's likely that you're going to see a premium increase at the next renewal. So from a risk financing option standpoint, a lot of times we've seen, if you look here on the left of the chart, the traditional insurance plan. That's where you're fully insured, where you're in part of a what's called guaranteed cost program. You pay, say, $100,000 to your carrier for your work comp coverage. There is no deductible whatsoever, and the carrier incurs all of the losses. As you creep to the right, you see how it gets more and more towards a self-insurance model. And really, that's the goal for any organization, is to become so well-run, well-managed, where the losses are so little that you can become self-insured, and you also become your own insurance company. So if you look back at the 60 to 70% of that dollar, that piece could potentially become yours. It could become back to you as the organization as your losses go down. And that's the goal here, is to really, get a grasp of your loss history, get a grasp of the loss experience, so that it leads towards potentially getting into a self-insured model, as opposed to just paying money to the carrier and having a great year and not getting any returns out of that. How do the insurance carriers underwrite the business? So this is what's called insurance exposure basis. So really, it kind of goes by per line of coverage. And apologies to some of your folks who already know this, but a lot of times we find that folks don't even realize how the underwriters are rating the operations. From a property standpoint, it's done what's called total insured value. So that's the cost of your buildings. That's the cost of the stuff in your buildings. It's first party things. It's all your things. What is the total cost to replace that in the event that the hand of God came and wiped all out? That would be the total insured value. From the auto standpoint, it's the number of units. And to dive a little bit deeper, it's what type of cars you're using. Is it just regular passenger vehicles? Is it shuttles? Are you carrying residents? Are you taking them somewhere? How do you secure them? How often do you have drivers who are rated, and how often are you looking at their motor vehicle records? So really, the auto is based upon the total number of units. From a GL and PL standpoint, typically, and this really applies mainly to the senior living world, it's based upon bed count. And as you can imagine, the independent living versus the assisted living versus the skilled versus hospice, it all varies from a rating standpoint. And so what the underwriters like to do is have a bed count of how many beds in each sector the organization has, and then they apply that to the rating. From a workers' compensation standpoint, payroll, obviously, and also what's called classification coding. So each state has what's called class coding, and it's essentially what the multiplier is for that specific job type. Clerical will typically get the least amount of rating, but a lot of times we'll see workers such as CNAs have a little bit of a higher class coding. So that's typically used in the workers' compensation standpoint. For the D&O coverage, typically it's gross revenue, as well as in cyber liability. A lot of times we'll have the underwriters ask us, what's the revenue of the company? And also, what's the total number of records that are being held or housed by that organization? And that's what the carriers will be using to underwrite the cyber piece. We've received some questions in the past with regards to just, how am I handling my insurance renewal? And these are sort of the main top 5, I'd say, questions that we would get from clients typically. First being, should I use one carrier or should I use multiple carriers? When we're putting together the renewal program, we always like to have as little carriers as possible as part of that program. And the reason there being that we don't like to have an adversarial sort of approach to the carriers. We like to have the carriers knowing that they're going to pay out claims. There's not going to be an argument with regards to what type of coverage is stepping up, whether or not the exclusions apply. So we really like to kind of aggregate as many of the lines of coverage under one roof with a carrier as best possible. And it also allows us to have a little bit more leverage when it comes to negotiating from a pricing standpoint. A lot of people like to know, should I be in my own program or should I be in a group program? It varies, to be quite honest with you. And the reason being that in a hard market, it's always best to have a group together, but in a soft market, it's always best to go out and shop on your own. So it really varies as far as what sort of scenario that we're seeing right now from a market standpoint. But a lot of times we've seen groups like risk retention groups, captive arrangements, other collective groups that allow us to really go out into the marketplace on their behalf with more than just one organization. And all of a sudden, you get a little bit more involvement from a carrier level because the opportunity is that much greater. Question comes up a lot of times is, should I use a broker or should I go direct to the insurance company? I'm a little biased, but I will always say to go to a broker. And the reason being is that when you are placing coverage through a broker, it's not you paying the broker. It's the actual carrier that's going to be paying them from the commission, as I mentioned before. But also the broker knows how to negotiate properly with those carriers. We maintain relationships with a multitude of carriers who we know are invested in senior living and human services, but we're also aware of the exclusionary language that sits in the policies for each of these carriers. And I don't know if about you, but if you open up the insurance policy, say your GLPL policy, it's probably about 95 pages long, and it's this and shall and must do that and accept that. No one has time to read that stuff. That's our job. And so what we like to do is parse through those policies and then come back and have the presentation to our clients as far as what is included in the coverage, what is not included in the coverage, so that we can have a business decision as to whether or not that's the carrier that we want to work with. Exposure considerations can be talking points sometimes. And what I mean by that is a lot of providers we've seen over the last few years implementing ancillary services, home and community-based services, hospice, home health. We've seen some clients of ours start their own therapy company. And as you can imagine, that's a little bit of a different exposure as opposed to just a straight up CCRC life plan community exposure. And so those are considerations that need to be had when you're placing the policy for that renewal program and making sure that the policy is keeping up with the operations at the organization level. How often to pressure test your insurance program broker? We know a lot of times, especially for the not-for-profit providers, there's almost some due diligence that has to be had every a few years to really test the relationship. Ask the hard questions of your broker and say, are we getting the best that we can get from the person or people or office that we're working with? A lot of times we find that our clients go through the RFP process, and we encourage them to do that because we know that when we're going through that RFP process, the questions that are being asked are questions that we're going to be able to answer, as opposed to most other sort of generalist brokers out there who only sort of go on a higher level for insurance and aren't really invested in the senior living human service world. So let's talk about the current insurance market environment. And I always like to go pre-COVID because that's always a good start, because things changed so drastically during COVID and afterwards. So before COVID, it was really what's called a soft insurance market following the recession. And what I mean by that is that the rates were really, really going low. A lot of carriers were involved, and the opportunities for renewals to go below the premiums that were coming off were great. I mean, there was a lot of opportunity for us. And as you can see here, the rates bottom out around in 2017. And there was a performance gap between not-for-profit and for-profit providers. And what I mean by that is that all of a sudden the underwriting community at the carrier level didn't really give as much value to the fact that it was a nonprofit or a for-profit. And as I'm sure all of you can imagine, there is a big difference. At not-for-profit level, there's mission driven. Folks are really invested in the organization, as opposed to the for-profit side, where it's more of a, unfortunately, I like to say it, but a heads in beds approach and just turning tables and getting money. And insurance carriers know that, and they know for a fact that the folks who are working from the not-for-profit level really have much more investment in the organization, which will lead to potential lower claims. We also saw after around 2017-18, there was several carriers really kind of got out of the game altogether. And it was because of the fact that that loss ratio, the claims they were paying out versus the premium they were collecting, was going well over the 100%.
Looks like we have a freeze. Kim, are you seeing that as well too? Okay. Hang tight, everyone. We'll try to get Ralph back on the Zoom.
That sounds good. Just waiting for it to come through. I do have a question in the interim, though, if we can go ahead and answer. We have have a question that came from someone. Cyber seems to be a hot topic right now, and I know that, in fact, I know two of our providers that have had issues in the past year with one was actually a ransomware demand, and then another was an issue of proprietary information being hacked, really. So thinking about things like that, what are some of the recent trends that you're seeing with cyber coverage, Raf, and what exposures are you seeing? Are there any new things that you would advise us to look for?
Yeah, definitely. So that's a very good question. And the very first word that comes to mind is ransomware. What we've definitely been seeing over the last, I'd say, 18 months or so is ransomware attacks where the hacker comes into the organization somehow through a firewall or through a hole, and basically sits there and says, I'm going to watch the activity, and then I'm going to hold your infrastructure hostage. I'm going to take your records and hold them hostage. And I will only give them back if you pay me $500,000. And I've encrypted all your files. And if you don't give me the money, you're not going to get your files back. That's been a very, very active claim type over the last 18 months or so. And what carriers are starting to do is, instead of providing the full policy limit for coverage from a ransomware attack, they've been starting to sublimit that piece. And what we've been doing is pushing back on it, trying to sort of walk the carriers through all of the good things that they're doing from an infrastructure protection standpoint, from a preparation proactivity standpoint. But again, I'd say that ransomware is definitely one area that is kind of gone on the uptick over the last year or so. Elsewhere, I see insurance rates, while they are stabilizing a little bit, we're expecting them to kind of go back up in third, fourth quarter from a rate standpoint. And then finally, social engineering attacks. As I mentioned, these hackers will come in and they'll just sit inside the organization and watch the activity, and they don't have to do anything for whatever time they prefer. And they watch even the calendars of the executives. We had one client where the hacker came in, and we found out later that they'd been there for about 8 months, literally just sitting there watching activity. And they watched the calendar of the CEO, and the CEO went to a dentist appointment on a Friday afternoon. And the hacker crafted the email that made it look like it was coming from the CEO saying, "I'm at the dentist's office right now. I need that W-2 for this person," or whatever it was. And sure enough, that was the hacker that was tapping in, and not the actual CEO, but it was because of the fact that this hacker had observed for a lengthy period of time before even doing anything. So we found a lot of our clients start to loop in their heads of IT when we're talking with the insurance carriers, because those are the folks who can confidently talk about, what security measures that are implementing. And if there are problems or there are things that have been identified by the carrier that need to be fixed, that head of IT really is the one that can confidently talk about it and move the renewal forward. So it's definitely a Wild West sort of time period right now for cyber, but we find that with ample preparation, discussions with the carriers, and really giving yourself enough of that runway to adequately prepare for the renewal and to review all the options that come on the table, that's the best way to do things. So I hope that answers your question.
Yeah, thank you, Ralph. While we are waiting for the slides to pull up, and we may or may not be able to get those, and we'll make sure everyone gets them. Ralph, are you comfortable kind of continuing with your presentation without the slides and kind of walking through folks some other key insights and observations?
Yeah, certainly.
Yeah. Okay.
Certainly. In the meantime, what I'm going to do here, I'm going to try just one more time here to send this as a PDF, and then I will, hopefully that'll be helpful. Hold on one second here. Here we go. Okay. All right, Kim, I sent you the PDF, and hopefully that'll get through quick. But what I'll do is I'll just pick up from where I left off here, and then if it comes through, by all means, speak up and then let me know, and I'll tell you where I'm at, if that's all right.
Yep, that sounds good.
Okay. So as I was speaking about before, so the insurance market post-COVID, if you had really asked any underwriters to look out and say, what is going to happen over the next 18 months, 2 years, 3 years from a claims activity standpoint after COVID, I don't think a lot of people were able to confidently talk about what they foresaw or what they expected. And as a result, when underwriters don't know or can't underwrite to the future, they need to know how much premium they need to collect so that they have enough to invest, but also to pay out claims. As you recall, you saw that dollar bill that we chopped up. The underwriting community doesn't know what to do. And so as a result, they'll pick up premiums a little bit higher than usual. And that's where the market hardens. And post-COVID, from a liability standpoint, we saw increases of upwards of almost 20 to 50% from a premium rating standpoint. We also saw carriers start to implement what we like to call cumbersome underwriting requirements. All of a sudden, these underwriters were really going on to the nursinghomecompare.gov and getting as much information as possible about the organization before even opening up the file and looking at the application. And we also saw a lot of communities were forced to choose between large increases from a COVID being covered standpoint versus choosing an option or a program where COVID coverage was excluded. The question was, are we going to get sued for COVID exposures from adult families or from elsewhere? And so that sort of decision had to be made from a COVID standpoint as to whether or not we wanted it covered within our program. And again, I think I mentioned this before, but what we saw post-COVID especially was a lot of carriers just step out of the game altogether, which then allowed us to have a lot more, I say, diminished carrier appetite. There weren't as many carriers who were involved from a renewal standpoint, which then allowed those remaining carriers to increase premium rating, knowing that there were no other options for communities. From a property standpoint, post-COVID, you can imagine that there was a lot of hefty increases from a premium standpoint because back to the what would it take to repair, replace your building? That's the number. Post-COVID, labor costs, construction costs, material costs, all have been going upwards and upwards, especially after COVID. And that volatility and that increase was trickling down into the premium ratings. Couple that with the fact that there was 18 separate billion-dollar weather climate events in 2022, totaling about $165 billion. That was a problem. And the carriers started to get a little skittish with regards to what premium rating they were implementing. And now that what we saw were carriers coming back and saying, we need you to go out and re-rate your exposure. That building that you thought was worth $50 million last year is probably now worth $65 million or $70 million. And that needs to be reflected in your schedule of values, which then, as a result of increasing that value, that increased your premium rating as well. Elsewhere, we saw another reduction in capacity, similar to the liability world. We saw property carriers start to step out of the game. And we also saw the carriers who remained start to have a little bit of an unwillingness to write coverage above a certain number. Say, we'll provide you with the property coverage, but it'll only be up to $100 million in total insured value. And that can be problematic for those organizations that have a total insured value schedule of over $100 million. So that was a big problem, and we were kind of scrambling to find carriers to make sure that they were properly protected for those organizations. I'm going to skip over some of the charts here. I'm going to go over to slide 20. From a claim standpoint, and again, this is how the underwriters really look at the risk that is the organization. And I said before, a lot of times they're required to underwrite to the future. When they get an opportunity for renewal, they'll look at the file, they'll look at the loss runs, they'll look at the applications, and they'll say, what type of claims are going to come down the pike for this policy year? And what they do also is they look at claim trends within the general market. And what we saw is that the average cost of claims, especially in assisted living, started to exceed the cost of claims in skilled nursing. What we saw was about a $267,000 average per claim in assisted living, where in the skilled setting, we saw about a $245,000 per claim. The largest claims that were emanating from this sector were resident falls and pressure injuries. Those really took up about 2/3 of all the claims, with about 60% of fall-related claim allegations involving residents with prior history of falls. And so that really tells us, when we're looking at those claims and those loss data, is saying, what story are we going to tell the underwriting community when we're going through the renewal? They're identifying the fact that 60% of fall-related claims have residents who had a prior history of falls. So what are you, the organization, doing to mitigate those fall claims? Really, it's all about the story. It's about the narrative. And that is why at JKJ, when we finish a renewal, immediately afterwards, we're sitting down and saying, what are we doing this year from an action plan standpoint to attack the potential claims that are going to come down the pike? Because then at the next renewal, that is the information that we're going to be providing the carriers, so that we are putting ourselves in the best light possible, so that we can get the best coverage, the best rating.
Right. Ralph, we're able to get the slides back up. So you just let us know which slide you want us to be on, and we will make sure we're on.
All right. Yeah, let's jump to slide 21 there, the current insurance market environment and claim trends.
21, you said?
21, yep.
Yep, 21, okay.
Okay, so really from this standpoint, this kind of gives you a quick and dirty sort of understanding of the average type of claim for each sector within the senior living world. And really the question is, where skilled is the 24/7 service providing area. Assisted living is not independent living, but also not skilled nursing. And then your independent living, which is really just your almost real estate exposure type. And really the assisted living area was the biggest problem, because we had what we called acuity creep. A lot of times, once a resident goes into the assisted living sector, maybe he or she are better set for a skilled setting, but they're remaining in that assisted living setting. And so what we're seeing is The services that are being provided maybe are a little diminished when it comes to, what sector they are being in. Let's go over to the next slide, number 22. You'll see here again, resident falls comprising over 40% of the claims activity within the senior living sector. Elsewhere, we're seeing pressure injuries and pressure ulcers being a problem, improper care, failure to monitor, delay in seeking medical treatment, etc. Really, the narrative here is that we want to be taking these claim trends and saying, let's put them on a piece of paper, and we're going to address every single one from an organizational, operational standpoint, so that we can go back to the carriers and say, we are aware that we have resident falls, but here's what we're doing to combat those falls and to mitigate those instances. Let's move on to slide 23. And this is just another way of looking at those top 8 allegations. As you can see down the bottom there, elopement is really the biggest problem from a dollars standpoint. And, again, the question becomes, what are you as an organization doing to mitigate elopement claims? And, what are you doing to address all of these potential wrongful acts happening within the organization? Because that's really all what the carriers want to do. They just want to paper the file during the renewal so that when a claim happens, they can look back and say, yes, we provided this coverage for them, but this is why we provided it, because they said they were doing X, Y, Z to limit elopement issues. But again, the question is, what are you doing for each of these claim types to combat them from happening over and over and to mitigate them as best possible? So let's go to the next topic here, the insurance renewal best practices, and we'll jump over to slide 25. And this is really what I
Kim, one
when
back,
we're talking
please.
to.
Yep, there you go.
Yep. All right. So really, this is what we're talking about when we're sitting down, well in advance. So let's say we have a January 1st renewal for an organization. Already right now, within our office, we've met with our clients who are 1/1 renewals and had that stewardship pre-renewal strategy meeting and said, what are we doing from a renewal standpoint? Where are the bad claims coming from? How are we going to spin this in the right way with the carriers? Are we going to market the program? Are we going to go out to the market and shop for a different carrier? Or are you, the organization, happy with that relationship so that we can keep it out of the market, which then makes the organization look a little better? Are we going to do a risk control visit? Are we going to have our folks go out and do what's called almost like a mystery shopper mock OSHA audit, where our JKJ safety team comes out and walks through the community and puts the hat on of OSHA or the carriers and say, I'm going to point fingers at all the things that I see that need to be improved. And I'm going to generate a report that then allows you, the organization, to action plan and scratch off as you go through to eliminate those, so that when we have the real visit from OSHA or the carrier, we are as buttoned up as possible. From a carrier access standpoint, a lot of times we find that folks don't really like to deal with the insurance carriers. I understand why sometimes, but we like to make it a collaborative event as opposed to an adversarial process. We want to loop in the carriers and have them involved as best possible, because that is when we know the partnership is being had with the organization. That is when the carriers are involved just as much as the organization and the broker, so that it is not an adversarial process during the times their claims are happening, or we need to really tap into the assistance that the carriers can provide. From a submission process standpoint, where are we going to the market? Who are we talking to? And instead of just shotgunning a renewal package out to any carrier who will take a look, are we going as far as being laser focused and coming to those carriers who we know are invested in senior living, in health and human services? And those are the ones that we want to tap into, because we know that those are the ones who have the best knowledge base and resources that can be had for our clients. And are we providing community access for the carriers, or are we keeping them away, keeping them at bay, which is going to cause some problems in the long run? We want to be as collaborative as possible. We want them on the community level. We want them visiting us. We want them coming out and seeing all the great things that are going on. Sometimes I even ask the clients, is you have your golf outing, you have your gala, whatever it is, are you inviting those insurance carriers as well? Because that is where you make it a personal relationship beyond just having an insurance carrier who's just going to provide coverage for you. We want to make it a personal relationship because we know that'll be the best investment for our clients. Go on to slide 26. So from a liability standpoint, from a best practices standpoint, you need to know what your losses look like. And I know a lot of people look at their loss data, their loss runs, and it's kind of hard to discern where the problems are coming from. But that's where you need to rely on your broker to really translate those Excel spreadsheets to identify where the losses are emanating from the organization level, because that is what the underwriter is going to be doing when they're looking at the renewal process. Own the claims that are happening. And again, talk about what are we doing to mitigate those claims on a go-forward basis. We're going to present that action plan that's focused on lowering the claims experience, obviously. Instead of just saying, hey, here's all the great things we're doing from sort of a high level, we find that really getting granular from a claim standpoint and taking over the driver's seat during the negotiation. When we come in and talk to carriers and say, we are aware of the fact that at our organization, we have a problem when it comes to resident transfer. That being said, this is what we have been doing to educate our staff on proper resident transfer techniques. Carriers appreciate that approach because more often than not, many organizations don't do anything and instead just kind of cross their fingers and hope they get the best program by not really getting involved from a loss standpoint. A lot of folks out there have CARF or Eagle or some other organization that will come out and do a best practices analysis or a risk management review. We want people to leverage those accreditations. We want the carriers to learn about what accreditations they are and why they are best in class and why they should be giving deference to those folks who have the CARF emblem or whatnot. Also, we like to see folks who are investing in proactive safety measures, doing those mock fire drills, doing the staff education. A lot of times we find that for some clients, they're just too busy and they don't have time and they aren't invested in educating their staff with regards to risk management techniques and the things that can be done to mitigate claims. But we find that those clients who are heavily involved and really invest in doing those educational trainings for their staff, they're the ones who always look better in the spotlight when the carrier is starting to review the file. And again, you want to be evaluating the deductible retentions, the limits, benchmarking your program up against similar sized organizations. And you're only able to do that by working with a broker that has the expertise within that specific industry. And as you can imagine, with JKJ having over 350 organizations within our portfolio, we're able to take that data and compare it in favor of our clients so that they know that they're keeping up with the rest of their competition. And we're going to go to slide 27. From a property standpoint, best practices, be prepared. Really, a lot of times we're finding that the carriers are coming out and saying, what safety measures do you have within your building? What are you doing to protect your building as best possible? Are you sprinklered? Is it one contiguous building, or do you have fire doors in place between them? We've seen a lot of capital improvements and organizations start to do renovations and builds again. And we've gotten a lot more involved because of the fact that the questions are coming out is, what is the insurance implication going to be when we finish this building? Instead of using the frame woodwork, which we find a lot of our not-for-profit clients use because of the fact that it's so cheap, really consider the investment into a masonry non-combustible type or some other fire-protected material that allows you to be a little bit better buttoned up as opposed to just being a wood-framed building. We want you to be evaluating your replacement cost portfolio. I think I mentioned before, total insured value is a key when doing the property coverage, and values have gone up over the last year or two. And so what we need to be doing is conducting appraisals of your organization, of the buildings, to make sure that the numbers that you're putting on the paper that represent how much you think that building is worth has to be accurate and most realistic as best possible. Invest in proactive safety measures, as I mentioned before. Really focus on the fire protection for the building and make sure that we're eliminating any of the hazards that surround the building. And those similar issues also apply to the builder's risk, those new construction pieces. So property coverage is meant to protect the first-party stuff, the buildings, and all the things in it. And there's typically exclusionary language within the property policy that says we, the insurance carrier, will not pay for construction-type loss. And that's where the builder's risk program comes into place. You want to make sure that the builder's risk program is properly structured to adequately protect you during the renovations or capital improvement stage. go on to the next slide.
Raf, just time check. We have about 10 minutes, so
Yep.
maybe there's
Yep, sure.
1 or 2 closing slides, and then we'll get to hopefully some questions.
Yeah, sure. So let's jump over to the cyber piece real quick, and I'll fly through this. Let's hit slide 30, if that's okay.
Yep. Mhm.
So from a cyber insurance standpoint, that's the elephant in the room. We definitely know that market has just kind of been turned upside down. As you can see here on slide 30, healthcare really is the second most targeted sector from a cyber insurance standpoint when it comes to incidents and claims activity. Let's jump over to slide 31. We see all these articles that have been coming down the pike as of recent, where we see cyber criminals are becoming more and more frequent. Really, it's a black market activities out there. I mean, the Ukraine crisis caused a lot more of that uptick in cyber claims to come up, and that's become a problem across the board because we find that those not-for-profit providers out there are the low-hanging fruit when it comes to hackers and what they can do to hack into the organization level. As a result, what we've seen is carriers start to price it out a little bit heavier, which has then caused rates to go up as well as coverage to be stripped away. So really, it's our job to make sure that that doesn't happen for our clients. If you go to the next slide, 32, you'll see here, I remember a couple years ago, I had a couple CEOs come to me often and say, I am not going to buy cyber insurance because it's a joke. I said, you will be hacked and you will need cyber insurance. And as you can see here, from 2020 to 2021, you had almost a double in the premium, direct written premium that's being bought by organizations out there from a cyber insurance standpoint. Go to the next slide, on slide 33. You remember me mentioning loss ratio. It's the premium collected over the claims that are being paid out. There's been a little bit of an uptick in 2020 and 2021, up from 44% back in 2019. And so what we're seeing is carriers are now starting to get hammered a little bit more. And as a result, they're starting to kick premium up a little bit. So really, slide 34 kind of gives you the best approach from a sort of look ahead standpoint. As capacity is stabilizing, pricing has started to flatten out a little bit, might start to go up a little bit as we approach third quarter, fourth quarter. But again, if you involve your head of IT in the renewal process and give yourself enough time to get through the renewal, to fill out the application properly, and to have competent discussions with those carriers who want to write your business, you should be okay. When they issue their quotes, you want to stay on the alert for ransomware limitations, as I mentioned before, as well as cyber war, cyber nation state sponsored attacks. Sometimes we see hackers coming out of the Ukraine crisis, and that can be labeled as a cyber war attack. And a lot of times there's exclusionary language that will prevent coverage from being paid out for that stuff. Widespread event exclusions have been happening, and also this trend towards inside-out underwriting. What does that mean? Inside-out underwriting is that even before you've thrown your opportunity out to the carriers, those carriers are, I wouldn't say hacking into your systems, but they're taking a look at your website. They're looking at the back of your website and the ins and outs of your website and your cyber structure and how you are put together. And we're finding that the carriers have started to get a lot more intelligent with regards to the questions that are being asked and required of from a condition standpoint for providers. So I know we have about 5 minutes left. And again, I apologize for the power outage, but I think that probably gives you a solid idea of what we've seen lately. And again, I'll be happy to provide the PowerPoint. And I guess now we'll take any questions that have been coming up.
Yeah, Raf, thank you so much. Super thoughtful presentation, analytical presentation, as well as your insights. So appreciate that. So yeah, we'd love to turn it over to the call. Folks, we're a relatively small group. Go ahead and come off mute or put your question in the chat. I'd love for you to come off mute and ask your question of Raf while we have them.
Hi, Raf. My name is Marissa, and I'm with Social Current. So we do COA accreditation. And so I saw that you mentioned accreditation in your slides, and I was wondering because we do the entire organization. Some entities do one specific program. Is there a difference among, among the rates if it's a specific program, one or more within an organization, or the entire organization being accredited? Some Lutheran Services of America organizations are accredited or COA accredited. So I just asked relating to that.
Yeah, no, That's a good question, and I you know, unfortunately, and a lot of times we get asked this is, you know, if we are, you know, this accredited, does that equal a certain number when it comes to a rate reduction? The answer there is typically no. However, we, the broker, the representative of the organization, when we're going out into the insurance market, if we're supplied with as much knowledge, as much ammunition that is the positive news that is about the organization that we can provide the insurance carriers, they then will take that information, put it into their file and say, this is why this organization is best in class, or this is why this organization is unlike the general market from a loss standpoint. So again, while those accreditations really aren't ending up in a sort of automatic reduction, they definitely are helpful when we, the broker, are educating the carriers on all the good things that the organization is doing from a risk management standpoint. Does that help?
Yes, thank you.
You, Marissa. Other questions? I know we had a question about the recording. Absolutely. We always share these recordings. Happy to do that. We did get a question. Someone said, I'm taking over a relationship with our insurance broker. We're going through the renewal process. What should I expect and when in that process?
Yeah, good question. And again, I think the time that you give yourself, the more time, the more runway, the more room between right now and the renewal, the better off you will be. And you know, a lot of times we'll find that carriers don't want to take a look at the file until 60 days out or whatever from renewal. We push back on that and we say, you know what, we need to get our January 1st renewal done sooner than what you prefer. And so that then allows us to get those questions back from the carriers sooner than later. But again, I think that really giving yourself the time is going to be the most advantageous for you. Elsewhere, we also find that doing that sort of, you know, risk control visit, you know, having one of our guys come out and do a walkthrough of the organization and saying, here's where we would point fingers if we were OSHA, if we were the carrier. Here's where we would tell you that you need to change things. Because then when the real thing happens, you're as best buttoned up as possible and ready for the real event. But again, getting out in ahead of it, regardless of how far out you think your renewal is, will be the most advantageous for you.
Perfect. I think the other part of that question before I wrap up is kind of, if you're kind of assuming the responsibilities that someone else was, you know, handling this before, anything in particular, any types of things they should really be reassessing, I guess, in this climate and kind of looking at.
Yeah, definitely. You know, I think getting a hold of your loss history, you know, looking at the workers' comp losses, looking at the liability claims, seeing where claims are emanating from, will then allow you to sort of put on the underwriter's hat, the underwriter's lens, and say, this is how they will look at us. Because then what you do is you take that loss data and you craft the risk management plan for that year and saying, what are we going to do instead of just opening up the fire hydrant and, you know, taking as much water on as we can?
Yeah.
What are we going to do to be laser focused in addressing our specific claims activity? So if you have a better grasp of your losses, that will allow you to really hone in on where the biggest problems are coming from.
Thank you. Well, thank you so much. We are at the top of the hour. And first, I want to thank our attendees for joining and for your patience with the small technical difficulty we had there. I really appreciate you all sticking with the call. Nobody dropped the call, so really appreciate that. And thank you so much for sticking with it. Really want to thank Raf Hachiski from JKJ. Raf, thank you so much. I was struck by how thoughtful your presentation was and how insightful, and clearly you really seek to build a strong relationship with clients. So we really appreciate you sharing that viewpoint, kind of thought process and perspective, as well as all the analytical information to help people make good decisions. So grateful for that, and grateful for your partnership with the Lutheran Services in America community. So thank you for that today.
Thank you very much. I really appreciate it. Sorry about all the hiccup there with the power going out, but again, the PowerPoint has my email on it, so don't hesitate to reach out anyone has any questions that come
Absolutely.
up after our call.
We put Ruff's email there in the chat, but also you'll have the slides with his contact information. And as always, hope you attend other strength and service webinars. We have a great mix of some that are a little more business oriented, right? Some that are more program oriented about the impact you're trying to create and the change in the world. So hope you'll continue to join us. And thank you for being part of Lutheran Services in America. So thank you all for today.
Thank you so much.